Welcome to today's US Open live webinar. It is Thursday, November 9th, 10 minutes before Wall Street opens as always. I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. It's been a light calendar since our last sessions with only today's data from China standing out, which showed enhanced deflationary pressures. So we're going to talk about that and how this also plays into the broader weakness in oil prices. And despite this weak calendar in terms of releases, there are many important developments, mostly from the corporate world. Overnight, Disney reported an increase in subscribers after 3 straight losses and overall improved financials and generally upbeat messaging, and its stock was up in pre-market. And we also saw smartphone giant Samsung turning heads by stepping into the generative artificial intelligence arena with its own large language model, as rival Apple risks falling behind as it remains tight-lipped around its plans regarding this transformative technology. So these are some of the things we're going to be talking about. Of course, we're going to also talk about the technical analysis of EUR/USD as always, and the Nasdaq. Before, however, we begin, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed in this session does not constitute investment advice and should not be taken as such. Let's give you a few more seconds to do that before we begin. Okay, let's get the ball rolling. We have quite a few and exciting things to cover. We're gonna start with EUR/USD as always, which we already have on our screen. Then we're gonna talk about the slump in oil prices. We're gonna talk about US oil, and we're gonna tie that with the weak consumer, the weak inflation report, actually, consumer and producer from China, the world's second largest consumer of oil. And then we're gonna discuss the Nasdaq, which shows some exhaustion after its recent relief rally. Then we're gonna transition into Apple and how it has reacted to the news that Samsung is stepping up its AI game. And then we're gonna talk about Disney and its results and how markets reacted to them, and also, of course, about the technical analysis of both those companies. And as always, we're gonna round things off with what's ahead over the coming days. Now, in terms of EUR/USD, not much has changed due to lack of catalysts, and as markets, of course, await speeches by Fed Chair Powell later today and ECB President Christine Lagarde. Of course, we don't know if they're gonna comment on policy and thus have a potential impact on the pair. In any case, EUR/USD rose last week due to the Fed's dovish tilt and the poor jobs report, which enhances prospects of peak rates. This gives it the opportunity to break above the 38.2% Fibonacci, which would bring the 50% level in the spotlight. However, the common currencies has squandered this chance so far and does not inspire confidence for a meaningful rebound. It rejected the aforementioned 38.2% Fibo, and this keeps it in a precarious position for a return to the 2023 lows located at 1.0447. Although a catalyst would probably needed for a breach. The Fed did not close the door to more tightening, and in any case still preaches a prolonged restrictive stance. The ECB, meanwhile, also has turned dovish and hinted to peak rates, and inflation has fallen sharply based on the last preliminary readings, and the economy is in a very bad shape. The US economy, on the other hand, is doing very well. So that could force the Fed into further tightening, as we said. Now let's turn over to USOIL. It is running its second straight losing month, unraveling from the initial boost from the Middle East war which erupted a month ago. Fears have subsided and the conflict has not spilled over, at least so far, while demand concerns seem to be on the rise. The first batch of October data from China has not helped. Factory activity in the biggest importer of oil contracted again, while today's releases showed enhanced deflationary pressures on both the consumer and the producer side. CPI shrank by 0.2% year over year, and PPI contracted by 2.6% year over year, staying in with the latter staying in deflationary territory for a year now. US oil is now exposed to the 72.23 support, but further slide would likely need fresh impetus. On the other hand, the move seems stretched technically, and personally I think it's also a bit excessive fundamentally. Massive oil output cuts from OPEC Plus are still in place. The Middle East conflict remains a source of risk, and the Fed has turned less aggressive while its economy outperforming. Oil prices find support today, and an effort towards the $80 mark would be reasonable, but strong catalyst would be required for more, while the upside definitely looks hostile. You can see how there are many roadblocks, starting with the 200 period EMA, the black line on the chart. Now let's move into the Nasdaq. It posts a relief rally, as we have already talked about, after the Fed's dovish shift. We've covered that, and the weak NFPs, and also mostly helpful tech earnings. It shows some exhaustion since yesterday, and this could create downward pressure back towards the 200 period EMA, which you can see here at around 14,890, but a significant deterioration in sentiment would be needed for daily closes below it that would hold the bullish bias and potentially open the door towards last month's lows. In any case, this recent rally has brought bulls back into the driver's seat, and despite some exhaustion, as we said, they did clinch higher highs and have the 2023 high in their cross hairs. It's the 15,946 resistance, but we are cautious at this stage around further advance towards the record highs. Okay, with 2 minutes in the US session, let's turn our focus to the Samsung Apple battle. Apple has slumped in the third quarter, and last week's quarterly results disappointed once again with the fourth straight quarter of declining revenues. iPhone sales, though, showed resilience, and the increasingly important services segment hit new records. Another focal point, of course, is Apple's generative AI strategy. Let me just remind you that generative AI is the main battlefield in Silicon Valley after the release of ChatGPT by OpenAI nearly a year ago, with many companies racing for AI supremacy. Now, although there are reports that Apple is working on such a technology, the company has remained cagey, and during the earnings call, last week's earnings call, CEO Tim Cook only said that the company has work going on the technology. So that creates some concern that it may be falling behind on this arms race that could shape the future of everything, essentially, not just the smartphone market. On the other hand, Apple is typically tight-lipped around such things. However, yesterday we had rival Samsung, smartphone maker, of course, one of its activities at least, turned heads with the unveiling of its own large language model, which can facilitate composing emails, summarize documents, translate content, and enable smarter device control. Now, it's unclear to what extent and how fast this can be incorporated into smartphones, but that is but it looks like that is what Samsung works towards, and progress could be quite fast because its mobile division offered more insights shortly after around smartphone implementation on the technology with Galaxy AI, which the company said is coming early next year, and touted features like AI live translating calls on the fly. And of course, with the next Galaxy S24 flagship expected early next year, we don't know the official release date, but there are reports that it could come early next year. It looks like Samsung could be the first smartphone maker to incorporate this transformative technology into its smartphones and beat Apple to the punch if, of course, the US company doesn't do something before that. Now, even though Apple stock reacted negatively to last week's poor quarterly results, it continues its recent recovery and did not actually mind from Samsung's progress on AI, helped, of course, by the broader relief rally in Wall Street. It moves past, still close, but moves past the daily Ichimoku cloud. And this brings its record highs just below the $200 mark in the spotlight. Now, the move looks a bit stretched technically, though, and the valuation is lofty given the lack of revenue growth. So there is risk of a drop back towards the 200-period EMA. at around 172, but daily closes would be below it would be required for buyers to shift back to the downside and potentially open the door to further losses. And now let's turn our attention to Disney, which is in a rough patch, and its stock reflects that, having lost more than 50% since the 2021 all-time highs, and actually breached the pandemic lows last month, depicted by this dotted green line. Its traditional TV assets are struggling due to cord cutting and soft advertising. It still has it has a disappointing performance at the box office this year, and its streaming services have been losing subscribers. However, the company has been trying to turn things around, and yesterday's results were encouraging. Streaming services added subscribers for the first time this year, although remaining behind Netflix. The financial of the segment continued to improve. The ad-supported tier is doing very well, and the firm is looking to crack down on password sharing, a move that worked well for Netflix. And what this does is offering a growth runway, since if you can turn those sharers into paying members, you immediately increase your subscribers. Now, sports-oriented ESPN was another bright spot, and Bob Iger plans to transition this to streaming and unleash its full potential. Sport content is increasingly important and can draw big crowds, and is also well suited for ad placement. The CEO offered upbeat messaging, and the market reacted positively. You can see this big jump on the chart today as a result of these earnings and the messaging. And now it has a great opportunity to move back above the 200 days, sorry, EMA, and challenge the $100 mark. I do believe that the company has great potential, and this slump doesn't necessarily do justice, but just because it had hit such lows doesn't necessarily and immediately means that it can rally from those levels. And even though the company has great potential, there are still challenges ahead, which could create further pressure on the stock. These, of course, consist to increased competition, to a still adverse external environment with high inflation and high interest rates, and the two big challenges for the company moving ESPN into streaming, and potentially offloading or turning around the non-core, non-performing assets is not an easy task. And Mr. Iger did not actually offer anything much new compared to who we've had heard previously. So there is still risk for renewed pressure, and it has to do more work to turn things around. Now, that's pretty much it for today. Let's quickly, as we still watch how Disney does, let's quickly talk about a few things that are coming up over the next few days. We have Fed Chair Powell today and ECB President Lagarde both later in the day. Mr. Powell had adopted a softer stance after the last policy decision, the rate hold, than previously. So it will be interesting to see if he maintains this dovish bias or walks that back a little bit. ECB President Lagarde is typically non-committal, but the central bank has hinted at peak rates without, of course, shutting the door. Tomorrow on Friday, we have UK GDP figures. The economy has performed generally less bad than expected, and the last 3 quarters it had avoided a contraction. And the BOE is looking to stop tightening after 2 consecutive pauses, but every hike risks plunging the economy into a recession. And the Bank of England actually downgraded its projections and now sees zero growth, sees stagnation next year on the condition that rates have peaked. So that's why I said that every hike past current levels risk a recession. Next week starts a little bit slow, but high impact releases are due on Tuesday, mainly with the US CPI inflation update and the UK jobs data. While on the earnings front, what stands out over the next few days is Chinese EV startup Li Auto. That's it from me for today. Thank you for joining me. We will talk again on Tuesday on our usual time slot, 10 minutes before Wall Street opens.